It's Wednesday, July 30th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to take you through the rest of this hour as the futures market closes at 5 Eastern, 4 Central. The band's back together. It's good to see both of you here at the same time once more. If you're on the platform, Tasty Trade. If you're on the website, tastylive.com, welcome to the show. Come over to YouTube. Tell us what you think of these Microsoft earnings saving the NASDAQ here. Stock closes at 513.24. We can go right to the charts here, Paul. 513.24. We are now bid up to 541.62. They beat on their EPS, 365 versus 338 expected. That's an 8% beat. Revenues at 76.44 billion versus 73.83 billion. It's a beat of 4%. We look at EPS, that's up 24% year over year. Revenues are up 8% year over year. Revenues are up 9% quarter over quarter. So much for that Fed meeting, which no longer matters, which cheekily, I was going to say, Dylan, prior to these Microsoft earnings coming out, it's going to turn to you for your reaction. For a market that fell back to the lows at 11:40 a.m. Eastern time, it didn't really seem like the market was all that bothered with what the Fed had to say, but now it's just delighted that we have excellent tech earnings in front of us, which as we close out this day, this could be a session where we look at a NASDAQ now closing at a new all-time high on this Fed Wednesday, Mr. Radigan.
I mean, I'm the one who said stocks up in the last discussion. Would like to say. And we've been talking about optimistic tech earnings for days here. I mean, this is what we've all been hoping for. I think that, I think that the fake out was not the tech earnings. Everybody's been looking for big AI numbers. Everybody knows that the AI adoption rate is at, light speed at this point. The only question is, what was with the Fed fake out was the issue. But, I mean, this is going to come down to the horsepower of the AI revolution, which is clearly bigger than any piece of technology ever in the history of the world. And sort of traditional macroeconomic analysis of inflation versus rates versus growth versus sort of the overall sort of headwinds and tailwinds in the economy. But I do think that it's not an unreasonable point of view to say that conversation, while it has merit, and this chart shows it, is very easily overwhelmed by the magnitude of the AI revolution.
Ilya, it's good to have you back here. The last few days I've been talking about Icarus flying into the sun, how it feels like being long in this market. And there was part of me that was going to come in today and have this whole thing saying how it's very poetic that the market hit an all-time high while you were gone and it comes back and the wings finally melt off. But as any good trader would, I would have to change my mind when new information presents itself. So howdy, I don't feel so bad about holding on logs. Maybe these wings aren't melting yet. What do you make of this now that we're able to reconcile these earnings subsuming whatever weakness we had after the Fed?
I don't know that there's a whole lot to hang on here. What have we learned in these earnings that the market hasn't been riding for ages and ages now? What have we learned in these earnings? I mean, yes, everything that Dylan just said about AI adoption, which, depending on which forecaster you look at, is either faster or slower. The Economist, for example, was bemoaning how slow it's been relative to some of the headier forecasts just in last week's issue, for example. But that's neither here nor there. I mean, clearly these are excellent earnings, but which part of this story isn't discounted in the markets already? I mean, yes, we have explosive.
Meta earnings are out here too now, and I have to interrupt you. Yes, EPS please. Estimate of 589, 714.
Blistering.
Blew it away. Revenues, 44.83 billion, 47.52 actual, up 8% here after hours.
Very strong. There's there's absolutely no question.
The piece that's not in the market, Ilya, is just the rate of change. It's that the money's flying in, that the adoption rate is higher, and the money's flying in faster, and the Microsoft and the Meta earnings are proof positive of that statement.
Well, right. So again, the question is which part of this don't we know? Because if you look at sort of the thrust of this narrative, let's go down kind of the things that we learned just today. We learned that investment was a diminishing influence on GDP in the second quarter. For all of this AI hype, investment actually took away from GDP. It didn't add to GDP. We learned that consumption rebounded only a little after being the weakest since the COVID quarter, the COVID recession quarter, in the first quarter, after revisions to those numbers. So yes, these individual companies and their very now bloated market cap, they continue to get flattered. But what's the economy doing? It isn't looking all that great. So, and at the same time, you have a Fed that's very clearly resistant to cutting in the near term. The markets have only 34 basis points now baked in for this year, even as they have 78 basis points for next year. So the markets have decided that we need lots of rate cuts and that we're not going to get them and that they're going to come late. And they didn't like it today. So yes, of course, we're popping in after hours in trade that is thinner than thin. Asia hasn't even opened yet.
Do you think Asia's going to have a problem with Meta's earnings?
I don't think Asia is going to necessarily even out what's going on here. It's not a lot of liquidity, but I do think that Asia is going to care a lot more about the Fed than they are about this.
Becky, I say it's game on, party on, game on, let's go.
Better be. I have these 23,700 strike expiring tomorrow, Dylan. You know, like it's
going to be fine, pal.
I just need 50 points. What's 50 points in the, come on, 50 points in the NASDAQ between friends. Like we just did that in like 5 minutes. I need 5 more minutes here, folks.
It's month end in Asia today, so you might just get it. Whatever money doesn't want to jump off the month end wagon, maybe sticks around at least until tomorrow. It's already the 31st for Asia and Europe today, and maybe they don't run for the hills just here, just now. So maybe you get 24 hours, but I don't see anything in these earnings that says anything about anything other than these companies. And these companies are not going to save anyone or anything if the broader market tips for economic reasons. And we saw a lot of evidence from the Fed and from the GDP data today to suggest that's well underway.
I don't know, Dylan. Maybe that HVAC call the other day was the tip off. Ilya, I had the most unnerving call with an AI agent that had I not asked it how its day was, when it responded, "Don't worry about me, I'm a virtual chatbot," I would have had no idea. And it said, oh, if this little company, family founded and owned since 1989, is able to deploy this in the suburbs of New York City right now. And yet Tom wasn't so impressed because it was a secretary. But like, clearly this is starting to have penetration even into small businesses. And as we learned from the DeepSeek arrival and announcement back in January, as we broke down here on the show, after DeepSeek Monday, this would actually increase demand for inference long-term as we move into applications, right? The training itself doesn't take a lot of GPUs. It's having them widely available for human use and application is what requires the GPU. Sure. So 24 more points still in.
Well, I don't think we have a debate amongst us as to the revolutionary nature of this technology and as to the promise of it. I think the question isn't that at all. I think we agree on all those points. I think the question is which part of that story, besides these incidental earnings right now, which the markets are obviously very positively surprised by and rightfully so, outside of this, which part of this isn't in the broader narrative? And therefore,
I think the answer is that this is much faster, that it's much bigger and much faster and much more money.
I think we'll see.
Much money.
I think this is the kind of thing.
Huge amounts of money.
I think this is what you see. Well, right. But huge amounts of money can also be spending $1 million on a pets.com ad for the Super Super Bowl. So the question is, where is the start of the hype cycle has ended, the build out part of it is in the price, and maybe it's not all the way in. I don't think anybody knows where that is, but I think we're all collectively looking for the moment where basically the .com bust analog happens. That doesn't, of course, mean that the great and powerful telecoms future doesn't follow thereafter. It absolutely does. The question is, where is maximum hype cycle? And maybe this is it, and maybe it's not. We'll see. But I'm not making any sort of determination that this is necessarily the beginning of the next big leg higher in stocks when the S&P has closed down for a third consecutive day, by the way, on net just today. And that's after we kick the can down the road on the cliffhanger with China. We reach a trade deal with the EU. We get a 3% growth quarter in the second quarter, which beats expectations, and stock markets still can't rally. I'm not gonna look at this and say, oh, well, you got a pop on very solid earnings, but still one quarter's earnings in a very well-worn narrative in no liquidity, and now all of those other things don't matter. I don't think that we can make that call.
Hey, Dylan, can you believe how much money Meta made in the quarter that Trump did all that tariff nonsense? Imagine what happens when they have a clear business environment ahead of them.
Well, I mean, if they make that much money, do they care? So does it change?
I'm saying this is like an old expectation. That's what I'm saying. I'm saying this is like a wall of economic. This is a massive wall of economic transformation that's bigger than anybody understands, including the stock market, and it renders all the other generally otherwise meaningful considerations secondary or irrelevant.
We were not bullish enough on Meta, which was up 30% from the lows in April. Like, the market was not aggressive enough on its expectations for how much money Meta made. It's astounding that these shares or this company of this size is able to move this much after hours. I'm blown back by, dare I say, fellow Westchester County public school system graduate, Mark Zuckerberg. Can I take credit for him, Dylan? Is that allowed?
You can have.
You went to Briarcliff.
Sure.
So no, but Ilya, this is kind of, I'm even, we were looking for something to kick us up.
It's very impressive.
This is wild to me. I mean, maybe the chat has a different level of understanding or expectations here, but I'm just looking at these numbers, at the earnings, the revenues. NVIDIA's had the problem in the past where the numbers are going up, but the rate of growth is slowing. We're now starting to see reacceleration. And if they could do that in this quarter when basically the bar was lowered and companies have been using the opportunity to basically guide lower, and the internals of most earnings weren't great, right? The blended growth rates were coming in. They were going to be the weakest they were in 2 years. This is just an absolute slam dunk, Dylan. So maybe we get one more day of window dressing here where we can push a little bit higher. I'm still very concerned about what April may wrought with its rise in volatility, but these 1 DTE NASDAQ call spread, this is that's on the tastylive follow account here. At least that's going to work out. And whenever I have in my PA, maybe there's a shot for that. I was feeling a lot worse before we came onto the show. I'll tell you that. That looked like wasted money. So you'll have to excuse my relief.
I think there's a very good chance that you get a good close to the month of July on Wall Street. I think we're going to have to really see how the month close looks in Asia and in Europe, because that's going to be telltale. It's been telltale all week, as a matter of fact, ever since we gapped open with the EU-US trade deal at the start of the week. There was every reason to think that the global growth picture has become better when you took away uncertainty about the trade relations of the 3 biggest contributors to GDP. kicking the can on China, getting a deal with the EU. There's been no better news for the global economy in months and months and months, and stocks didn't care. This is very, very interesting now as we go into August with a Fed that doesn't meet again until September. Yes, we'll get Jackson Hole. That'll be interesting guidance. But the Fed doesn't meet again in September. The GDP numbers are not encouraging despite the headline number, because once you look under the hood, the pain is in the parts of the economy where you don't want it. It's in consumption. And you look at all of this together and you say, okay, what do you have going? You have AI hype. And it's strong. It's very strong. But that's it. And all the valuations are already there.
Robinhood likewise came out with earnings here. Just to recap, because some people may have been joining us late, we had Microsoft, we have Meta, we have Robinhood out as well. They had an EPS of 42 cents, beating the estimate of 0.34 cents there. Revenues are up 1.01 billion, which beat the estimates of 98 million. Share prices not as enthusiastic as the Microsoft and Meta counterparts, which are dragging this market higher. Meta out. EPS of $7.14, which cleared the estimate of 587. Revenues are 47.5 billion, beating the consensus forecast of 44.8 billion. Microsoft itself, very similar strong numbers here. Share prices again up in this neighborhood of 6-7%. EPS of 365 against a forecast of 3.30. Revenues of 76.4 billion against forecast of 73.8 billion. Dylan, I think perhaps I'm taking away the lesson here is that the market cares more about the reality of what under the hood than some of the noise and narrative that we're hearing from our Federal Reserve officials, our elected officials in DC, President Trump himself.
It also makes you wonder about the estimates.
Go
why
on.
It's so hard for them to. Why were the Meta estimates so wrong?
Are we wrong about the space? Are you suggesting? I mean, you have suggested that.
I'm just asking the question whether the entire analytic, because you're talking about the analysts in the Fed or the commentary and the politicians. I would throw in there the entire sort of Wall Street forecasting analyst community. You're bringing up NVIDIA. It's a perfect example. I mean, there was a couple years there, a year and a half there, where the NVIDIA estimating infrastructure was so absurdly useless. I mean, everybody remembers those early beats from NVIDIA where the gap was, just it made the estimates look comical. And I just feel like for a company the size of Meta, to your point, and as highly analyzed and studied and one of the most liquid names on earth, for the forecast to be that wrong, for me, suggests that there's a lot of people that think they know something that they simply don't know.
Mm-hmm.
And I just wonder whether that's where we find ourselves once again as in an NVIDIA situation where the forecasting machine is just, it's like the same as the presidential polls. I mean, that the system of analysis is non-functional.
Well, this is one of the most interesting kind of dichotomies that you get from these kinds of earnings and the second quarter GDP numbers. Because if you look in aggregate, right, not just this space, but if you look in aggregate, investment pulled away 3 percentage points from overall GDP. So while overall GDP grew 3%, that was a makeup because imports added close to a little bit over 5 percentage points, and consumption added about 1 percentage point. So we're looking at a situation where investment actually amounted to the biggest hurdle to economic growth in this quarter that these companies are now reporting on. And it's because of all of these shenanigans with inventories. So in the first quarter, inventories surged. In this quarter, they started to get drawn down. So we're getting very different visions here. These companies are obviously selling a lot of AI, and they're obviously building a lot of AI infrastructure that they want to then sell. Obviously, the capacity expansion in the space is much faster than certainly the markets anticipated, looking at the difference in forecasts and the realized results. But what is that doing for the overall economy? Apparently, it's a drop in the bucket once you get to the influence of inventory and import swings vis-a-vis the tariffs. And so this is where I think you really get to a place now where you have to look and see what the markets care about more. My sense is they've been running on this AI build out for a long time. And yes, we're getting confirming evidence. Sure, no question. But the overall economy is not seeing these things in aggregate. They're being subsumed by downside forces. And the Fed isn't coming to help, apparently, in any kind of a near-term sense. Maybe we'll get 2 cuts this year, but the markets are very suspect on that at this point. And so, as ever, and I think you and I have agreed on this, it becomes a question of valuation. And for now, the question of valuation has been resolved in a bullish direction. And on the back of these earnings, I mean, the markets are obviously cheering them on. There's no question. Also, liquidity is non-existent right now. So I'm going to be very interested to see where all of this settles within 24 hours.
That's why I started the show with the quip that, it's a nice economy that we have here. It'd be a shame if we didn't have to hike rates. Because I think the undercurrent of what Powell said, there was a remark where I don't think he really beat around it. I sent it to Nick over in the chat. What was the exact comment here? You could say that the Fed is looking through inflation by not hiking. The Fed is looking through inflation by not hiking, as if they weren't looking through the recent bump up in inflation, because inflation is right now closer to 3% than 2%, they would be considering a rate hike. Which, quite frankly, where does that leave us in the bucket, Elia, if we do get a rate cut in September? I mean, that doesn't sound like the Fed is that concerned with downside risks to the economy right now. It would sound like it would be more of a maintenance rate cut than a recessionary one or an emergency one. At least that was my interpretation there. Did you have a different view on how Powell spoke about the path of rates? I know one more point there. I know someone's surprised that he didn't pre-commit to September. The Fed doesn't really do that. It has to be a unique set of circumstances for them to offer forward guidance that strong. They haven't really been doing that in recent years. So I don't think that was a knock on Trump or anything.
No. I don't think that really meant anything. The Fed is not in the business of overtly signaling what they're going to do next, unless it's some sort of an emergency or some sort of critical situation. Or, for example, at the end of last year, where they had forecasts for 100 basis points in rate cuts, they delivered half in September with 2 meetings left. And then everybody's like, well, so what are you going to do at the next 2 meetings? And like, well, there's only one way this math works out, so we'll see you next time. What are you asking? Like, unless it's completely obvious or there's an emergency and the Fed feels like it needs to calm the markets with very overt guidance, they don't commit ahead of time. And indeed, what you got in the statement today was they took away the part in the statement that said uncertainty had diminished. So actually, they see elevated uncertainty. It's not diminishing. And the remarks from Powell were, I thought, interesting in the sense that I don't think actually they were leaning in a maintenance cut direction, because one of the things that Powell very clearly said here is he acknowledged the arguments made by Waller and Bowman, both of whom dissented in favor of a rate cut this time, and said that although uncertainty is elevated and we're not close to clear outcomes on the trade stuff that is making for this uncertainty, the Fed very clearly said in the statement that economic activity moderated in the first half of the year, and even Powell acknowledged the emergence of clear risks to the jobs market in this Q&A. So there's a very different kind of a conversation on growth here. I mean, obviously, for the first time since 1998, two Fed governors dissented, and they dissented in a rate cut direction.
93 for what it's worth. Even further back.
Even further back.
So it's more, as Josh would say, even more unique.
Michael McDonough's chart that he published earlier today. But nevertheless, I mean, we're talking about the 90s here. It's been a really long time. And so you have two Fed governors dissenting on growth grounds, wanting to go dovish. You have Powell singing the praises of those governors in the Q&A and saying it was a really great discussion, one of the best discussions we've had at a Fed meeting in my tenure. Everybody made excellent arguments, and there's been real risks to the jobs market that have emerged. So it doesn't look like this is a maintenance cut Fed. It looks like it's a growth risks rate cuts Fed, but that they are not going to jump lest they let inflation expectations out of the bag. At least not the majority of them. Dissents notwithstanding.
Dylan, did you hear or read anything about Fed Chair Powell's remarks today that piqued your interest? Were you surprised by how the market reacted?
I think that, I think that ultimately the economy is sort of muddling along, and so there's room for every idea. At this point, I do think, just I was listening to Ilya, I do think that it will be interesting to see what the July CPI number looks like.
Mm-hmm. Yeah.
Especially coming after June. I think that's more, I think I'm more interested in that than I am in whatever the Fed's doing. Because I think the big risk right now is too much inflation, right? Like that's the problem.
Like that's what ruins the party. If inflation keeps edging up, because then that means the Fed's further away from cutting rates. That means more pressure on the Fed from Trump, which just creates more perception problems, right? So like inflation going down solves everything. How did the markets read it today?
Well, let's take a step back. Before these explosive earnings, how did stock markets read a hawkish Fed? Badly.
Terrible. It was terrible.
The markets want cuts. Do they want cuts for maintenance reasons? Is that what they want? Not if you look at how rapidly they are pricing them in for next year. So the markets want these cuts, and they want them, it seems to me, for growth reasons. So if the markets were in fact extrapolating the great and powerful AI narrative being the tide that lifts all boats, why would they want these rate cuts so bad? Surely
like
they would not
cheaper
be
money?
But why so hungry if everything is fine? If you're so well fed on growth, if AI is keeping your plate just brimming with tasty growth prospects, why so hungry?
Dylan, one thing that came out on the other side of all this Fed action is our beautiful metals market got beaten down here. So for the bright and shiny spot that is now the NASDAQ here after hours. The metals, which have been so fun for us this year, they are starting to shed some weight. Can't help but notice that silver likewise dropped below 37.70. Ooh, that's no good. Let's go to that 12-hour chart, in fact, so you can actually see it play out. But silver prices here falling back into the previous trading range. This opens up the door towards 36. Elliot, we covered this on Futures Power Hour today.
Yeah.
Is this not the surest sign that the market has renewed confidence in wherever American policy is headed right now? The dollar here surging up versus the euro, the yen, the pound, gold, silver melting down. Isn't that you want to see on the other side of a Fed and a GDP report like today?
I mean, I think the question is what you think you're seeing, and sort of what all of the elements of it actually are. Because until these earnings that we just saw after hours, the readout from today was higher dollar, lower metals, higher yields, weaker stocks. All of that smells of essentially a market disappointed with a Fed that won't cut. So is it confidence in the US dollar not getting self-immolated? I mean, maybe to some extent, but if that were the case, we'd probably be looking at a different story in the bonds. I don't think the market has really cared about the dollar self-immolating since basically mid-April or so. And that's, of course, been the recovery in stocks. This idea that the worry that the U.S. was going to self-impose on itself some kind of finance ending destruction isn't going to happen. But that part of it was bark and not bite. And I think at the start of this week that you get stocks basically yawning at an EU-US accord on tariffs tells you the markets have stopped caring about this stuff. That this is much more straightforward.
Straightforward to what end?
Straightforward to the end that higher interest rates in the U.S., higher than any other developed economy, make the dollar a more attractive currency on yield differential grounds, that the dollar is oversold on those grounds. The Fed gave you more reasons to think that today, so you get a very straightforward dollar rally with yields, which is what you'd see in this kind of an environment. Gold weakens in the same kind of environment. It's all very, very textbook. This is not about the future of the dollar as the global reserve currency or the viability of U.S. debt as the risk-free asset base for the world. This is just about higher rates and the returns to be had from owning dollars in that environment.
Well, but Ilya, here's something that I want to just underscore. Even with that first quarter GDP report, with what's going on in the second quarter here now, the U.S. economy still grew faster than the European economy.
Sure.
In the first half of the year. So we're here shooting ourselves in the foot. The entire world is saying, oh, the U.S. is extricating itself from the global trade system. We don't need as many dollars in hands. The future returns of American companies are going to be lower than rest of world counterparts. So let's invest in European defense stocks and German concrete makers and blah, blah, blah for the big fiscal blowout.
Yeah.
And here, as we get to the halfway mark of the year, we can quibble, and I have my own issues with S&P 500 returns, particularly when you account for the dollar decline. But
sure.
Now you look at the turn of the year, we now have a U.S. economy that's muddling through, even with the self-imposed albatross around our neck. We're still growing faster than Europe.
Sure.
And maybe the European rebound trade was overplayed because guess what? This deal that we just carved out with them, roundly perceived to be bad for Europe. going to be more beneficial for the United States. So I don't know how it helps them resuscitate or revive an economy that continues to stagnate.
I don't know that's the reading that I have of it. It's obviously not good news for Europe because a 15% tariff will diminish demand for products in Europe to some extent. But they aren't the ones that are going to pay the tariff. U.S. businesses are, and U.S. consumers. And so to what extent the quality of this deal is going to hinge on whether the president got what he wanted, which he did, as opposed to what the actual economic impact of that will be. I mean, I'm much more focused on the economic impact than I am on whether the president got what he was bargaining for. Because what the president was bargaining for, we've already seen, of course, the huge numbers of tariff revenue that the administration has been singing about. But tariff revenue from whom? U.S. importers and consumers. Who is paying these things? It's not the countries being tariffed. They're seeing a loss of demand. But Europe has been anemic for, 2 years? They had a mild recession at the end of 2024. And they've been at basic standstill ever since. Who is actually paying these things and what difference does it make to them versus us? We've been the leg of the stool that cannot afford to fail at least since the middle of last year, when there was an aborted attempt at a rebound in Europe and in China. And it fizzled in both cases by mid-year. And those economies have gone nowhere since. So incrementally, what change does this amount to for those economies? Barely anything. If you look at what Europe appears to have gotten out of this thing, it's a much more assertive U.S. position on Ukraine. And looking at European history, the trading of economic imperfection for geopolitical goals and objectives has been the story of the EU since the formation of the initial three communities: European coal and steel, EU atom, and or Euroatom, and the initial European customs union in the 1950s. This whole thing has always been about geopolitics. It's always been about preventing another sequence of world wars on a continent that has been soaked in nothing but blood for thousands and thousands of years.
You're being dramatic. There's wine, there's fish.
I mean, it's a continent of countries that fought a 1,000-year war between England and France.
I would say that AI versus the muddled mess of the world, AI wins.
Eventually, I agree.
I mean, look at the battle was fought in this very chart before us today. The world tried to.
I don't think we know that yet.
Tried to spill blood upon us, and Microsoft and Meta said, "Not here, sir."
All we've done on the
Not
NASDAQ
today, sir.
All we've done on the NASDAQ is return to where we were at the highs yesterday.
Yeah,
we've poked our head above them. We've poked our head above them by a gopher's whisker.
Whoever, any whisker, it's the highest that whisker has ever gone. Okay.
For now.
Yeah, ever in history, not just.
And liquidity is non-existent when these things came out. Well, so, and I fully expect, by the way, that NASDAQ is going to be relatively well supported tomorrow as Wall Street.
You think that deal gets paid?
Probably. Yeah.
You get paid right now. All right, you get out right now and just run away.
Nobody asked you.
No.
I think he probably does, because I think we still have month's end tomorrow. The Wall Street cash market needs to absorb all this stuff. That's why I'm going to be watching Europe very closely.
Can we talk about the US dollar and why it's awesome?
It is awesome. I'm super per long now. I'm loving it. I've been scaling into longs all month.
Bro, I've been living on crackers and tuna over here. Okay, I've been needing this to flip
But very nice crackers and very artisanal tuna.
Yeah, Dylan, I'm pretty sure it was literally the 24th when you were saying how miserable it was taking like a pay cut this year because being paid in dollars, partially,
20%.
but you know, it's been a nice little 3% swing.
Got a raise today, baby.
Another raise, good for you.
Moving into the chicken breasts out of the crackers and tuna. So this keeps going. I'll be back in the steaks, but we're not there yet.
Yeah, I mean, I've seen it. I saw it at the liquor store actually because I don't buy scotch during the summer. I drink that during the winter, and I just happened to peer over at like if they had any Lefroy in stock to see what price was. $69.99 a bottle now. Those
Okay.
10 years are those are going for they were going for
Make that work.
$52.90. They were going for $52.99 a year ago, or last winter. So creeping on up.
They'll get
They're
you.
gonna get you. I'm gonna have to drink some
But I
Long
mean, what
Island
about
swill.
the Sosnofian hypothesis that this is it?
I don't think
There
so.
you go. You don't buy it, do you?
No, I think it has more to go. I think the dollar is gonna continue going higher here. I don't think there's any indication that it's slowing down at all.
Okay, but Dylan, more importantly, right? The dollar decline is predicated on the idea that the world thinks the U.S. is going to trade less with it.
Yes.
And if we're looking at these deals, there's going to be a lot of deadweight loss created by the tariffs, but it's not, the goal isn't necessarily, or the outcome won't necessarily be less trading, if I'm going to get there. And then directionally, in terms of the vibes, I know we all like to dunk on Trump for being a chicken, but I think from day one, we've been intellectually honest in saying, no, we want him to back off from these things. We're not going to chide him for it. This is bad policy. We don't want bad policy in place. So don't bait the guy into doing bad policy.
You're right.
The fact that there's a lot of flexibility here, tariffs are coming, maybe not August 1st. It's not a firm deadline. Are they going to be 25%? 15% or so. I mean, like this directionally, even though the language isn't great and what I want, it's directionally softer and better than it's been.
And
so,
to your point, the market is, if we believe in the market, as the market knows things, that dollar move was the biggest reaction to the tariffs of the last, however many months now, for 3-4
Yes.
months. And so this dollar move, I think, has to be taken serious. My bigger thing is not bigger thing, an additional thing I would say, in addition to everything we're talking about now, is the U.S. currency is not supposed to move around like Bitcoin.
Right.
no.
Like what the F is going on? Like this is supposed to be a store of value / global reserve currency / ultimate shock absorber stabilizer. And it's trading like a meme coin at this point.
Yeah, I mean, it's up 2.34% this week, which is an astounding move for the world's most liquid currency. I think this is just a function of the positioning in the market, where we have these very large euro and yen short positions, long positions, short dollar positions vis-a-vis the euro and the yen. We know that the rolling 20-year basis, the Z-score for the yen was over 3 at one point in April, going into May, and then it's still over 2 right now. And then the euro long position short dollar was, I think, at the 3rd highest reading ever. So this is an unwind right now of people who are placing bets that the dollar was this system as we knew it was done. And we have firmer inflation and higher growth, and our companies make big, beautiful things. Like what does Meta make these days, Don? Just AI, llama?
They just make
ads?
Satanic data harvesting to destroy the world.
Oh, well, it makes a lot of money.
Yeah, for
So-
sure.
Yeah.
No,
and
there's nothing more. It's more like satanic data harvesting and exploitation. But it's
And exploitation.
super profitable. Look at that.
We did this, Ilya, we covered this yesterday, and I'm curious actually about your thought on this. We're rounding out the idea. Maybe people in the chat have had time to think about it. What if the economy just muddles through like it did in 21 or 22? Like, where was the recession that was supposed to come once the COVID spending spigot turned off, the big fiscal cliff? It takes 12 to 18 months for the economy to digest rate hikes. Well, we're more than 12 to 18 months out from the last.
We know exactly what happened. But
what happened?
We know 100%, as a matter of fact, what happened. But we have had a bunch of tightening cycles, including this one. This is, and you and I have been talking about this for a good year. This is the only rate hike cycle in the advent of modern finance, when the dollar was decoupled from gold in 1973, finally, that companies' interest expenses, servicing debt, has gone down in a rate hike cycle, not up. In every other cycle, rates go up, companies pay more for credit, which is exactly what's supposed to happen. But in this cycle, they've paid less. Why? Because COVID. Because during COVID, they borrowed oodles and oodles of money for essentially no cost at all, and then didn't spend any of it because there was nothing to spend on it. Everything was on lockdown. And so they went into this tightening cycle with a war chest unheard of in 40, 50 years. But of course, you got to refi that money this year and next year at much higher rates.
Now, Ilya, you've been telling me for at least 2 years.
Yep.
The big refinancing face jammer, higher cost of capital, you got problems.
Yes.
Over.
Potential problems. Yes.
And we have yet to see it.
That's right. We have yet to see it because the refi cliff is basically beginning now. Because the war chest, as it turns out, was huge. It turns out that, again, this is the only tightening cycle in modern financial history where companies didn't have to pay more for credit despite higher rates. This has not happened ever since the 1970s when the current version of the financial system is born. So we're waiting. It remains a potential risk. It may not materialize. That's why it's a potential risk. There's no evidence of it yet. But the overhang very much remains, and the longer the Fed keeps rates elevated, the more of a risk it is, although considering the money was basically borrowed at zero, any kind of a refi cliff is going to be an issue. We saw it a little bit with the SVB shenanigans, but that was a little bit of a different animal. That was a pain from higher rates that was different than refi costs. And that bit of it is probably going to be more like the savings and loan thing. It'll bleed out the weak hands over time, and it won't be a crisis or a crash. But again, look at what we just saw in the second quarter. There is no investment in the economy, zero in the second quarter. But for shenanigans around tariff inventories moving back and forth. No company invested anything in the second quarter on net. Obviously, the AI story is huge. But when you put corporate investment as a contribution to economic growth in the second quarter all together, it was zero. These are not companies that are happy or looking to splash out money clearly. Could it be because they have to refi money at higher rates? Maybe.
Dylan, I also think of the idea that a company like Meta is not splashing out money, and so it's just able to do more with less. And it doesn't need to invest anything else, and it still can blow earnings out of the water. I'm kind of I'm in a little bit of a shell shock by how good that earnings report was, admittedly, just for the fact that the bar was already set so high.
And that
And
brings me back to the forecasting mechanism.
Yeah.
This is not like you're wrong about some little company that no one covers. This is
No.
probably one of the 10 most studied companies on earth. Pipeline, user rate, data value, ad spend, user engagement levels, blah, 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 blah. And after all the analysis, the street has no idea. Their forecast was meaningless.
To what extent does this echo the ratings agencies in 07 and 08?
Or the NVIDIA forecast from a couple of years ago, or the presidential polls.
Yeah.
so
Yeah.
so like just like a few years ago, the market was consistently underestimating the picks and shovels phase of the AI build out.
But by orders of magnitude, not by like, oh, not 15%.
Yeah.
Off, like way off.
Yeah.
And now
like off.
And now the biggest companies are starting to flex their muscles in a similar manner, which shows that adoption applications phase, actually mining for the gold, it's coming along much faster. The trains are on the tracks, Ilya, you know?
Well, I mean, do we know that though from these
do.
earnings, or do we see just the build out reaching fever pitch? Because I don't know that we see adoption accelerating in these numbers, although I think anecdotally, you very much see that adoption is proceeding at a very, let's say, healthy clip. If only because if you look at the last GDP report, companies are not exactly running out there hiring labor for the great and powerful economy growing.
Well, I mean, how many people do you know that still use Google compared to a year ago?
I think overwhelmingly most people still do, because that's the default.
I don't know anybody that uses
that's the default on their phone, and that's what they do. And anybody that does anything search wise does it on their phone.
I think that the number of people using Google search compared to AI search, I think that it is at least a 50% fall off in Google search.
I mean, maybe I haven't seen the numbers, but
neither have I. But I don't know anybody that uses. Everybody I know uses an AI search function.
Can we just talk about this real quick here for Meta? Meta's Reality Labs, which does all their virtual world nonsense, lost $4.53 billion this most recent quarter, and they still blew away expectations with that kind of overhang. This was just a few years ago something that was only losing a few $1 billion per quarter. Now it's what, $16-20 billion a year. So it's not like it's their Ray-Ban glasses, right? That's not what's powering this thing to the upside. It's all folks who are using it for AI. We can spin the treadmill.
For the record, my kids had an absolute ball with an Oculus headset on vacation.
Oh yeah, they're very cool. They're a lot of fun, but like I think people don't want to be encumbered into stuff, right? They want it to seamlessly be part of their lives. That's why the Ray-Ban glasses are actually meaningful, because they don't look weird. Remember the Google, right. What were the Google ones? Google Glasses?
Google Glass.
Those were like, how you looked like a real nerd wearing them. And like, as a young man, that doesn't help odds for certain activities in the world. But the Ray-Ban ones, like I have Ray-Bans right here. Like I've had them for 20 years.
You don't have to brag about it.
Yeah, well, I'm an OG. So, okay. But the point is like, if I were to switch over to the Meta ones, they're the same exact style as these that I have here on my desk. So you're not asking me to socially isolate myself from incorporating them into my aesthetic and, whatever accessories I'm wearing. And you're seeing this with more of the wearable AI tech. It's less bulky and it's more about integration, like an earpiece, what have you, rather than a chain with a, camera that you wear around your shirt. So, but the point is the demand is here. Microsoft Azure, 39% constant currency growth rate when they were forecasting 34 to 35% in terms of internal guidance. That's all AI. So maybe it leads to nothing, Ilya, but it seems like we're in another build out phase, at least with these mega cap tech companies. It's hard
in one. And
Or still in one.
And it's proceeding at a clip that certainly Wall Street analysts underestimated by a wide margin.
To that end, as we close out the show here, NVIDIA 179.27 at the close, up near 181 after hours. So spilling downstream. If these companies are able to make this much money, then why shouldn't everyone else just go get some GPUs? With that, Overtime is out of time for today. We'll be back tomorrow, same time, same place, back here on the network, 4 p.m. Eastern, 3 Central, right after last call. So for Dylan Radigan and Ilya Spivak, welcome back, gentlemen. I'm Chris Vecchio. See you tomorrow. After this, though, you have Ilya live again. He's here with Macro Money. See you there.
See you there, everybody.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move.
Global markets never sleep. Explore them with Forex on tastytrade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on tastytrade.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. That's what I do. Decision to build Thinkorswim was a byproduct or a derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
I distinctly remember getting an email from Tasty that Lookback had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was. And basically instantaneously, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring. And then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from Tasty Live to look at that. And that's when my consistency went from 1 to 30, and I haven't had an unprofitable quarter since.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Having trouble understanding what your trader buddies are saying? Here's what a scalp is. We love those quick profits. A scalp is a trade opened and then closed in a short period of time, usually minutes or hours. A scalp is usually done for a small profit and is typically a very directional position. Scalps are most commonly done with future products because of the liquidity and added leverage they provide. But you gotta be careful, it's not always a profit.
What a day to come back from vacation. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We've been off for about a week here, and what a day to return. We, of course, had the FOMC monetary policy announcement with us today, as well as some very interesting U.S. GDP data and all manner of market volatility around all of these moves. We're going to break it all down here and try to figure out what just happened and what it all means as we go through these outcomes and see what the markets did, see how the response worked out, and see if we can't surmise what all of it might signal for what comes next. So here is your S&P 500 down for a third consecutive day, albeit very narrowly. Clearly, the Fed's signaling not something that the stock markets loved to see. And a kind of goose egg result from the NASDAQ by the close. But of course, after hours, some explosive earnings from Meta and Microsoft, and not a bad result from Qualcomm either. So on the whole, it looks like we're basically back to where we were on the NASDAQ going back about 2 days here. So back to around here. And if we look at the overall chart, it looks like we're somewhere near the highs of this, if not a little bit over. We'll see how it all works out once the dust settles. But certainly, even on this chart, we can see stock markets did not like what the Fed had going. We likewise get a decline in gold, although it comes off a little bit off its lows heading into the close. And the U.S. dollar surging once again, it's been on something of a tear in recent days. And after it got to the top of its recent range here on the DXY dollar index, we can see it powered through those levels with gusto today on these announcements. The euro on pace to lose 1.25%, the pound off almost 0.9%, the yen off 0.7%, the Aussie down 1.2%, the Canadian dollar down 0.4%. So a very potent US dollar rally here. And of course, stock markets after hours rebounding, but the Fed itself, something that the markets take as a negative catalyst. So let's see if we can unpick what that was all about, and then, of course, put that in the context of this after-hours price action, what it might mean going forward. Here was the Fed's statement. It didn't offer a tremendous amount of difference from the June write-up, but there were some notable points here. We had this bit here about how swings in net exports continue to affect the data, and we'll take a look at that in just a moment as we break down the second quarter GDP report, which also came out today. But a number of interesting points here. So the language on growth has gotten more negative. So the part about how economic activity has continued to expand at a solid pace, that part of it gone. And the Fed now saying that economic activity moderated in the first half of the year. Moreover, this bit from June about how uncertainty in the economic outlook has diminished, that's been taken out. So the Fed now just sees economic activity as elevated, and that's that. Now, this was baseline for the Fed to leave rates unchanged as very broadly expected for this meeting. The markets had no expectation that the Fed was going to do anything this time around. But there's a number of things that have changed, and it is the number of people on the Fed's own governing board that have dissented. This is a chart from Michael McDonough over at Bloomberg, and he points out here in this chart that for the first time since the 90s, this is 1993 on inspection here, that we have had a situation where fully two members of the Fed's Washington, D.C. based governing board. This is not the regional Fed presidents. This is sort of the central board of governors that the Fed chair, Jay Powell, sits atop, and fully two of them wanted a rate cut at this meeting. And we haven't had this level of dissent on the board, as we can clearly see here, in a very long time. Now, the meat of this, interestingly, came, as one might expect, in the press conference. The markets, of course, had a very high level of conviction in the Fed not doing anything at this meeting, in the upper 90% chance that the Fed wouldn't do anything, and so it was. So the surprise really wasn't very much in the statement or in the action. The real fireworks came in the statements from Chair Powell. And he came out and said that uncertainty continues to be linked, of course, to the ongoing trade talks, saying we're not close to clear outcomes. But what's interesting is that at the same time, he acknowledged the emergence of clear risks to the jobs market and actually sang the praises of the two governors that dissented, saying the debate and the discussion at this meeting was one of the best that he's overseen in his tenure. So the arguments for rate cuts clearly remain compelling. In fact, Chair Powell included, the Fed has argued that we should be seeing rate cuts this year. And that's been the argument for quite a long time, going back over a year now. And for that, the Fed is very much consistent. But the key here seems to be that uncertainty on trade and the possibility that we still don't know how much of an inflationary spike there might be from these tariffs. And although Chair Powell very firmly said that this is expected to be a one-off, that the Fed wants to manage that one-off in a way that doesn't spill over into lasting inflation expectations. And so with that in mind, the Fed stayed its hand. The majority of the committee opted to hold pat. And the language that Powell then offered, speaking about this elevated uncertainty, seemed to suggest to the markets that even seeing a pair of rate cuts this year, which the Fed itself projected back in June, might be suspect. In fact, if we look at what the markets are pricing in now, we can see here that looking into the benchmark Fed funds futures, only 31 basis points are now on the menu for this year, whereas for next year, we are looking at 80. Now, this is a stark contrast with what the Fed itself is saying. They're envisioning only 75 basis points between this year and next, with 50 basis points this year, 25 basis points next year. Obviously, the market has other thoughts. They think the Fed is going to be more restrained this year, but have to do quite a bit of catch up because of that delay. And that next year, we will see at least 3, maybe more cuts, which, of course, the Fed has not endorsed yet, but neither have they updated their forecasting at this meeting. That won't come until September. And the markets clearly didn't like that. Again, taking away this very buoyant response to some of these tech earnings that came out in thin liquidity overnight, which we'll see how the dust settles on as that liquidity comes back in Asia and European hours, never mind what happens when Wall Street reopens for cash, for the cash session. The reaction to the Fed itself was clearly negative. So the markets want these cuts. They're signaling that these cuts are necessary, and they don't like that the Fed seems intent on a dragging out of when they will begin. Now, nevertheless, the Fed is still, for the most part, expected to cut rates in September. The likelihood of a cut is now about 55% in favor of no change, but that's still about half and half, looking at a situation where the cut looks likelier than not once kind of all of the dust settles. We are indeed still looking at 31 basis points and not less. But when we start to look at October, when we start looking at December, it starts to really clearly show up that the markets are suspect that any more than one cut is going to appear. And that's despite signs of economic weakness. Consider this GDP report today for the second quarter that, again, was riven with anomalies from the tariffs. We can see that the first quarter was revised down to a decline of 0.5%. That's a little bit worse than the initial negative reading that was reported. We can likewise see that this consumption number for the first quarter was aggressively clawed back. And now we see that in the first quarter, we had the weakest contribution to overall GDP from consumption since the quarter-long recession that was COVID. Ultimately, GDP was negative for only one quarter, and it was the reference point for these numbers. This is the weakest consumption we've seen since then. And of course, the reason we care so deeply about this, as opposed to what's happening here for imports and investment, which we'll unpick in just a moment, is, of course, consumption is by far the largest contributor to overall economic growth. We can see here 68% of GDP is consumption. Everything else is down here at a less than 20% contribution to the overall story. Now, when we look at then what is happening with these moves, in the first quarter, we clearly saw that a huge surge in imports was a major pull down on growth. The way that the external sector factors into GDPs, we take the difference between exports and imports. And if that's positive, then that, of course, adds to GDP. And if it's negative, it pulls away. Now, we can see exports were almost non-existent as a positive contribution, but imports surging easily dwarfed all of that, and dwarfed likewise where those imports went, which is into this investment component as companies tried to front run incoming tariffs and built up inventories. So in other words, this surge in investment in the first quarter was investment in inventory. Now you can see by the second quarter, imports swung hard the other way. That is to say, they were a pittance of their headwind in the first quarter, and in fact were actually an addition to GDP, largely because they stopped surging, whereas inventories actually went the other way. Inventories were actually a diminishing component on GDP, because ostensibly the reason that we were able to see imports basically fall away and become a positive contributor, largely by falling, is that we started to draw down the inventories that we built here. So, in other words, the front running of the tariffs, the accumulation of goods in anticipation of things becoming more expensive, started to pay off in the sense that companies started to pull from those inventories to be able to sell things to consumers without fully passing on the costs of tariffs. And we've seen that, of course, already in the PPI numbers, in seeing that companies are eating tariff costs at the front end of the supply chain once it arrives in the U.S., because, make no mistake, it is U.S. companies that pay these tariffs. And when they do, when they have attempted not to destroy demand downwind on the supply chain by passing the full cost down to wholesalers at the end of that supply chain, and then ultimately to consumers. And the way they've been able to do that is draw down the inventories that they accumulated in the first quarter for goods that were bought at a pre-tariff surge kind of a rate. Now, encouragingly, consumption rebounded just a little bit, but nevertheless, the overall story for consumption is clearly that it is diminishing. This, never mind this quarter here, which was obviously particularly bad, this number was actually the weakest consumption contribution that we'd seen since the second quarter of 2023. So this was the worst since COVID. This was the weakest in 2 years, but for the prior number. And so consumption here remains exceedingly weak. And if we actually look at the year-on-year growth in each component, we can see here that the consumption component has been steadily slowing, and in fact continued to slow from the first quarter into the second. The reason you don't see the investment component here, the green bar, is because net investment didn't happen in the second quarter. Investment didn't make any positive contribution to growth. It was basically close to zero. Because once you got around to all of the tariff shenanigans getting factored out of the equation, the pull from inventories coupled with the pittance of investment that was there, positive on net outside of that, left essentially a goose egg. Government spending continued to inch down. We can see exports were slower than they've been, really going back to perhaps here. And really the major change was imports, having surged aggressively, as we've just discussed, slowed down to almost nothing. And so what we're left with is a GDP report that suggests that the front running of tariffs has run its course. Now we are starting to actually run down those inventories, and it's only a matter of time before they have to be restocked at much more expensive cost, because, of course, now we're going to have to rebuy into those inventories with anywhere between 10 to 15 to more percent of a tariff. If we look at the kinds of deals that have been agreed with the major trading partners. And what we find, likewise, is that consumption, the biggest contributor, as we just saw, is flagging. And that, of course, is exactly the kind of thing that the markets appeared to be worried about in the first half of the year, as we've talked about extensively here, once we strip away all of the noise. If we take a look at what happened in the first half of the year, stocks, of course, rose, but they rose much less than the US dollar fell. So, factoring out the very flattering impact on US stock performance from an absolutely sinking US dollar, because, of course, US markets are priced in dollar terms, we end up with stock markets that were essentially anemic at best, down on net in any other major currency but the dollar. That yields, for all of the concern about the future of the dollar in global commerce, around the change in tariff policy, that yields actually, even at the longer term, declined. That is to say, the market had absolutely no problems buying long-term US debt, and that front-end yields fell even more around this building expectation for rate cuts. That crude oil fell despite escalating tensions and indeed a shooting contest directly, first between Israel and Iran and then the US and Iran. And all of this, of course, coming together to suggest that what we're looking at is a situation where stocks barely cleared historic averages. In the orange bars here is the 6-month performance average over a 25-year period, 7 years in the case of Bitcoin, because it's not been around for that long to really make the averages make sense. But Bitcoin aside, we can see we saw record-setting swings in U.S. rates, in the dollar, in oil, and stock markets barely managed to eke out paper gains. Paper gains, of course, because once you factor out the impact of the dollar, stocks were actually down. And so when you look at all of this together, you immediately get a sense that it isn't a world-ending dissolution of the US dollar and US Treasury bond situation that the markets were concerned about. It isn't some sort of geopolitical crisis. It's an economic growth risk. And when we look at these GDP numbers, we start to see the makings of that risk. As the most important component of growth, consumption, looks the weakest it's looked in, at best, a 2-year period. And if we look at these 2 quarters together, these were some of the worst back-to-back quarters for consumption in, let's say, at least 5 years. And that perhaps explains why the markets so much expect that the Fed is going to have to cut rates more aggressively next year, and why they were so disappointed with the signaling that they got today. And so while tech earnings overnight certainly are a flattering thing for stock market tracking futures contracts for now, the overall story here appears to be growth negative and concerned that rates aren't catching up, with all of its follow-on implications in dollar strength and in a weak footing for risk assets more generally. And that is Macro Money for today. As ever, we are here Monday through Thursday, back now to live right after overtime, a show I co-host with Dylan Ranigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Back with Chris Mondays and Fridays for Futures Power Hour in a special session today with Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money is back in full force tomorrow.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80-plus Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, of course, Dan Cecilia. Dan, how you doing?
Doing awesome. ETH 10 years.
Yeah.
Anniversaries today. If any of you don't know, ETH was launched this date in 2015. Went live in the public. So, yeah, we're enjoying that.
Were you part of the initial ICO?
No.
Were you that early?
No, I was not that early. I don't even consider myself that early in any of this, but hey, we're still here.
Real quick, what's crazy about this, and I think everybody can find this on either the Tasty Crypto YouTube channel or maybe it's on the Tasty Live channel, somewhere on the internet. But there is an early interview with Tom Sosnoff and Vitalik Buterin, and it maybe predates the ICO itself, where I think like even Vitalik is like trying to get Tom, not trying to get him to invest, but saying, hey, you could invest at the time or that early. That's crazy to me, but it's out there if anybody wants to watch that.
I had like a brief conversation with I think Tony about that, and I was like, so what did you guys think? He was just like, why would we need that? And I'm like, yeah, I guess.
Yeah.
I probably would have.
I mean, in hindsight, it's perfect vision, but like,
at the time, you're like, this is the craziest thing I've ever heard.
Exactly. Right. Yeah. Amazing. Dan, before we get started though, you're on the internet?
I am on the internet.
Where can people find you on the internet?
You can find me on Twitter. My handle's, I'll drop it here. It's
put it in the chat.
Truth.
What up, chat?
Dan C.
There you go. Follow Dan on Twitter for some alpha. I think you usually drop some truth bombs, some good alpha. I like reading your thoughts on there.
I definitely will retweet a lot of things that I find interesting. I use Twitter to do all my research. That's where I find all my crypto research.
Yeah.
That's where I'm early. I'm not a conspiracy theorist, despite the name Truth. I'm not a conspiracy theorist. I couldn't get Dan C, so I put the word truth in front of it. So you can follow me there. You can DM me. I'll answer your questions. I'll interact with you. But yeah, that's where I'm on the internet.
Hell yeah. And anyone else that's on the internet, I suppose you have to be if you're watching this, get over to YouTube, pop out the chat, type some crazy shit in the chat. Tell us what's up. We got Emmett here, Katana, Andrew Cortado, what's going on, Lone Sophos. Dan's even in the chat. You can interact with him live right here while we do this thing. But Dan, let's jump right into it. You mentioned 10-year anniversary for ETH. ETH's been hot right now, up over 100% in the last 3 months, though, believe it or not, at least for now, underperforming Bitcoin still on a relative basis. Where do you want to go? You want to jump into price action? You want to talk about some of what's behind this recent move? You want to talk about something other than ETH? I don't know. Where are you at?
I think we should take a look at some of the performance real quick, and then we'll get into. I think we just get into all about ETH. Like I really do think we should cover the 10-year anniversary a little bit, some of the what's driving ETH's run up, and then I put together a slide for you to go over the crypto treasury companies. I know everyone in the chat loves that.
Okay.
So I want to go over those and give them a chance to take a look at some of this stuff.
Beautiful. Well, really quickly, let's just take a look at a performance update. Maybe a little stale here. This is from 6:30 this morning. Put this in the Tasty Crypto email newsletter. Goes out twice a week. Wednesday morning market update most of the time, and Saturday morning all the time. So if you're not on that list, get over to tastycrypto.com, enter your email address, and you'll get the newsletter. Put a lot of our thoughts in there, trade ideas. Dan's got his lock of the week or pick of the week every week, so you can read that in there as well. But from this morning, came in, and I think we're around these levels right now, but about 118 on Bitcoin. It's just been trading sideways here. We're a little bit lower. ETH, pretty much the same price, 37.55. Solana has kind of pulled back to the low end of the range. And I think the general theme that you're seeing here as we flip through is while you're in a bullish market environment, you're getting that pullback you probably would expect after just the ripper we had at the beginning of July. Like 2 weeks, just everybody felt great, new all-time high in Bitcoin. Inevitably, you get a little bit overbought conditions and you get that pullback. I think it presents an opportunity. What do you think in terms of just double-digit price action to the downside here in some things, but everything taking a breather? How do you feel about it?
Yeah, I kind of echo that sentiment, right? We've had such a bullish July, kind of manic July here. ETH is up a ton as far like relatively still down on the year, which is kind of crazy versus Bitcoin. But I think we've just exhausted this run a little bit and we'll see a pullback. I think historically, not that crypto moves in the same way, but historically, like August is always kind of like we take a breather.
Gonna be quiet.
Summer. I guess if you want me to give sort of a range of what I'm looking at for ETH, I'm looking for it to pull back around 3,400.
Okay.
3,500 is where I think this pullback comes. Some of the stuff we look at on the chart and some of the technicals we follow, I think is showing that we're kind of slowing on that run up. Some of the majors, Sol maybe pulling back to like 150, 140, and then Bitcoin, could get back down around 110 if we're just looking at some of this. So I have, I'm not really necessarily buying a lot right here. I'm kind of waiting to see what happens over the next couple weeks. Fed announcement came out today.
Yeah, no change to rates.
No change, which
was expected.
Yeah. So I would just look for this run up that we had over the last month that kind of it's exhausted itself and we'll see a little bit of a pullback.
Yeah, that's the way that I'm trading it as well. I'm just quick check of the S&P futures right now, up 0.5%. So yeah, maybe a little bit of intraday kind of swings there, but not a lot of volatility. That remains the theme, whether that's when you look at the VIX here, which I think I've got, let me see. I've got the VIX at 15. Probably could go lower here if we get a quiet August, though there can be some surprises at times. Looking at volatility in crypto, I mean, Bitcoin implied vol at 37% is back near its yearly low, pretty much at an IB rank of 0, as low as it's been over the last year. ETH trending lower, though implied vol is almost double what we see when we look at Bitcoin. Still a premium in here, realized is lower than implied, so you get that premium. But when you look at those levels, based off of these implied volatility, I think kind of lining up with what you mentioned too, you could probabilistically see ETH down to 3,400, Bitcoin around 110 there. Here, the rest that we track, Solana hasn't moved more than $15, it seems, in some time, at least in terms of the expected move. But that's the way that I would trade it. You got to kind of be patient. Don't force things. It feels like, it's never going to get back down to that low end of the range, and then it does. Right. And sometimes pretty quickly. I, again, think those are opportunities, at least in this market environment. I think the macro backdrop, too, still supports it. Liquidity perspective or profile picture, whatever you want to call it, supports it as well. So quick look at what's going on in the market, and that dip, which I think is short-term, is underway. I guess elsewhere, Dan, let's talk about ETH a little bit here. A theme that we've seen over the last few months, and it's really starting to catch fire, is companies going out, raising capital, some new companies even starting, going public via SPAC in some cases, but companies going out raising capital for the purpose of buying crypto.
Yeah.
I think on the surface, people are like, what? That's got to be a bad sign, right? How do you think about that? Because it's really starting to pick up. And here you can see exactly what we're talking about. This is a graph depicting Ethereum crypto treasury companies and their aggregate holdings, which have completely exploded in really the last month and a half.
Yeah, so I think that this is kind of a bunch of people tailing what Saylor did with MicroStrategy and
with ETH this time.
With ETH this time, where they're able to kind of go out and, I don't know all the details, but they're able to go out and they're able to sort of buy into these publicly traded companies, issue more shares, use the money raised from the issuance of shares, go out and buy ETH and hold it on the balance sheet of these companies. And basically it's a easily accessible vehicle for the public to buy and get exposure of for Ethereum. So, we started seeing this kind of come into the public view back in early June. And you can see.
Yeah, I've got this is a headline from the Wall Street Journal about 5 days ago, but it's referencing the hottest business strategy this summer is buying crypto, of course. Since June 1st, 98 companies have announced plans to raise over $43 billion to buy Bitcoin and other cryptocurrencies. I've got to imagine a big chunk of that is strategy.
Yeah.
And we are looking at both Bitcoin and others. But just to put things in perspective, $43 billion has been raised for the purpose of buying crypto since June 1st.
Yeah, and if you go to the next slide, I have a comparison of some of the biggest ETH treasury companies compared to just ETH spot. And you can see here, one of the things that you want to take a look at is this MNAV, which is multiple of NAV, which is kind of how some of these traders are playing it, where is there a premium of, is it trading at a premium of what they hold in tokens, right? So that's what that MNAV is showing. But yeah, I mean, amount raised, SBET, $279 million to go out and buy ETH, Game, $80 million, Bitminer, which is Tom Lee's company, $268 million. And then this BTBT, which is like Bit Technologies or something, $402 million.
Okay, and that's just comparing. So when you're looking at that, the multiple of the net asset value, or that premium there, you're looking at net asset value. Let's take BTBT at the bottom there. Net asset value of $457 million, market cap, double that, 916.
Yeah, exactly.
Got it. Okay.
Yeah. So yeah, I think that's kind of been this trend, and you've seen that.
Do you think it continues?
I mean, I think where we're going to get to is they're going to start with Bitcoin, MicroStrategy, go to ETH, and now you're going to see these ones that raise for like altcoins, and you're already seeing it, right? Solana, UpXE, UPXY UPXI is one going to buy Solana. I saw one for Sui.
BitTensor, there's a couple maybe now.
Yeah. So you're seeing like these like altcoin ones happen, and I don't know if that tracks as well, right? Like I don't know. So you go further out on the risk curve here, but I think it'll continue. The other thing is we got to take a look at the flows of Ethereum ETFs because.
Oh yeah, let's jump to that really quickly.
Because I think.
Remember when ETH was dead?
Yes, exactly. Like, remember for the first year when these ETH ETFs launched, they were just like, "There's just no appetite for this. It's dead. It's not dead. This is just how the cycle goes."
It's going to be a different cycle this time, where it would only be Bitcoin. Which, to that point, Bitcoin has certainly outperformed to date.
Right.
But I still think we're 1 year or so post halving in the cycle. It might be early, but the narrative was different cycle this time. It'll just be Bitcoin sucking up all the flows and everything else is dead.
Right. Exactly. So that seems to have been proven wrong. I don't know. In past cycles, this always happens, right? Everyone piles into Bitcoin. Bitcoin kind of takes off. It outperforms, and then people rotate into ETH and other altcoins. That's how we get this rotation, right? People get rich on chain, people get rich in crypto, and they move to more crypto. They don't necessarily take it and move it back out to fiat. So that's this rotation you're seeing. And With the spot ETFs, you can kind of track that. Spot Ethereum ETFs, you can kind of track that. So we've had some of the largest record inflows for ETH ETFs over the last couple weeks. So I think that's what that graph on the right is showing there.
Yeah, the last data point I saw earlier in the week was something like 11-ish billion, a little bit over 11 billion in ETF inflows into Bitcoin and ETH combined for the month of July.
Right.
It's like blows it out of the water.
Right.
Absolute record. And big, like you mentioned, big inflows here. And you can see trading volumes starting to pick up as well in ETH ETFs.
And how do you look at those inflows? Is that like demand for ETH? Is ETH being locked up? Like that's kind of where I get confused is, okay, we got all these inflows. Sure. Like maybe it's buying ETH, but is it being staked? Is it being taken, is the supply going down or?
So at this point, I don't think that any of at least the ETFs that are listed here on U.S. exchanges can stake their ETH. That could be a catalyst where you could see an impact on some of the supply. But I just think of it, as capital flows into the fund, right? You're going to have a net inflow or outflow, and it's going to kind of ebb and flow, I suppose. But if you get consistent inflows into these funds that go out and then buy ETH, that's demand for long-term investment or short-term speculation, whatever it might be. But that should have an impact on the price, right? We're not going to be able to look at that and say, oh, for the most part, if we see this inflow, we're going to get this ETH price. Not necessarily. But when you have a massive wave of demand against the supply, and ETH can be disinflationary in terms of its supply dynamic or inflationary at times, there is an infinite amount in a sense versus a finite amount with a supply cap like Bitcoin. But if demand overwhelms supply, you're going to naturally get higher prices. If we jump to this next slide, I want to talk through that a little bit more. So let me actually go back one. 98 companies, 40-some billion buying crypto. This is just ETH, but just look at the rise here in token holdings over the last month and a half, and we can see what the price has done as well. When we compare this to Ethereum supply, so you've got all these companies that have come out and they've said, look, we're going to buy 50 million, 100 million, a billion worth of ETH, whatever it might be. It starts to really stack up. You can compare that to the supply growth of Ethereum via validator rewards. And we know there's a burn mechanism, and we don't have to get into the technicals there. But if we just look at supply growth of less than 1% per year, and this is based on the past 30 days, and it's just annualizing it from that rate. And this is from ultrasound.money if anybody wants to check it out on their own at another point. But we've got issuance running right now at about 3 billion ETH per year.
US dollars.
In terms of US dollars, $3 billion worth of ETH, sorry. If we see 10 billion, 20 billion, and I'm just making up like massive arbitrary numbers here, but if that starts to come in from a flow perspective, all kind of within the same time frame, I would bet on the price going up.
Right.
Right? Does that mean it goes to 4, 5, 6? Maybe. Doesn't mean it goes to 100,000. We're not calling for that. But this is just kind of the setup that we have right now. And couple of months ago, you saw a headline here, a headline there of this company is raising 100 million to buy a little bit of crypto. They're mostly in Bitcoin. Then you started to see some other tokens, and you've consistently seen this now around ETH. And I would imagine that it slows down at some point, but there's significant demand in addition to everybody that's building on this. And oh, by the way, JP Morgan Chase and Coinbase just inked a deal.
Right.
There's a lot happening that I think pushes this a lot higher, and it's right to focus on ETH at this point.
Yeah, I think so too. Where are all the applications being built? DeFi applications, some of the rails, like it is ETH. Obviously there's other use cases for other chains, and we oftentimes trade them too. But I think to your point about the setup, like the supply dynamics match what you're talking about or kind of support what you're talking about. You have all these public treasury companies buying up ETH. We're getting that rotation, that cycle rotation from like Bitcoin into ETH and probably other altcoins. Coinbase and all these companies are, building out infrastructure on it. It just kind of makes sense, I think, that this is sort of where we're at.
Yeah, I think there's a high probability we go up here in the next 6 to 12 months. I mean, that's the way that I'm playing it. You want to sell at some point, clearly. Timing can be everything in these markets. I'm trying to find an opportunity to maybe buy it slightly lower. 35, you had mentioned 3,400 here. So if we get that dip, we'll be active on the follow page. But one thing I want to take a look at, and Nick Batista mentioned this on Options Trading Concepts Live on Monday. We do the crypto version of the show. But he talked about the vol, and I think you had pointed this out to me, maybe it was today or yesterday, but the volatility in these SBET options at a time where, and I'm sure you're going to see this for others that have options, and we do have an earnings announcement upcoming on the 13th for this one, but the implied vol here on the upside in those call options is pretty wild versus kind of the lower implies that we're seeing on the spot ETFs themselves. And I think that also reflects the MNAV that you pointed out, where these vehicles themselves are trading at a premium to the net asset value.
Right.
Because people are looking at this as, a short-term speculative vehicle.
Right.
At least I think that's what that's signaling. Presumably over a long period of time, we see that come down a little bit. And the value or the price reflects the actual net asset value.
Right. Yeah. I again, like I'm trying to, I get this secondhand from some of the trading groups I'm in, but a lot of what they're looking at is this MNAV, this kind of like premium to net asset value metric. And I don't like, I guess trading that, if we're looking at the implied vol on some of these options.
This is wild, man.
Yeah. Like you're looking, I guess, August 15th, if you want to pull up on SBET. Yeah. August 15th, the implied vol at the money, 145.
Yep.
145. And then if you go to the ETH ETF, because that's what you're comparing, right? August 15th, which you have positions on in this, huh?
Yeah, I do. I've got some calls that I had owned earlier, have recently sold some calls against them. Maybe even look to buy those back. Don't have too much time here, but yeah, I've been pretty active at times in some of the upside calls here. But vol is not as cheap as it was. I would argue it's still kind of cheap, but a little bit higher underlying price. I think we were looking at a $19 price versus $28 price. But to your point, 66% vol here. The other thing that stands out to me, if we go back to SBET, look at how you do have the earnings announcement. But does it double off of that? I mean, look at so at $19 underlying, and you're still getting about, let's call it 50 cents to go out there to the 38 strike. Or if we just come in, I mean, you can see the 1 and 2 standard deviation moves here. You're still getting paid $1 to go another 10 points higher here to 29. That's a 200% implied vol on a per strike basis. You can buy the underlying for $19.56 and sell a call option against it at those levels.
Yeah.
And hedge a good chunk of your downside here too, if you wanted to buy downside puts, but I don't know why you would, right? When
that's
I say things
that's
like
actually
that,
a good trade.
When you should go out there and buy those. But yeah, you can do stuff like that in here. I mean, there's just really, these are kind of arguably pretty rich options on the upside here.
I think so, right? You said it. Like go out, buy the underlying, sell 2 standard deviations above. That's pretty good.
Yeah, that would be a huge upside move, which is what you clearly want if you're long the underlying. So there's a lot of trade opportunities out here now at this stage in the cycle, I suppose, or given what we're seeing in the market. You have the delta move in ETH, and that happened very rapidly at the beginning of the month. I think we go higher. But this is now becoming a bigger part of the narrative, and we're kind of on the other end of, ETH is dead.
Right. Yeah, I might actually take a look at this when the market opens tomorrow because I've been trying to figure out how to play some of these ETH treasury companies. I've been looking at them as just like, okay, is this bullish for ETH, spot ETH? Because that's what I do is I trade a lot.
Yeah. I think and I think the answer to that is yes, but at least for now.
But for like actually, I guess you would say profitable or opportunities in the actual options on these companies. I think what you just said, very simple, buy the underlying, sell this massive premium, the upside, or even just, try and sell, sell the premium.
Yeah.
Right.
And I think on the other side of that, and what Nick had mentioned on the show too, if anybody wants to go back to that, you look at maybe opportunities to buy low vol in the spot ETFs versus selling vol in some of these vehicles that are trading at a premium when we look at it from the MNAV or MNAV.
Gotcha. Okay.
But I think just the fact that this is it's not often that you see, don't get me wrong, it could go down, but and again, the market environment we're in, at least for now, seems to be pretty bullish. It's not often that you just see something where it's like $19 stock price and the upside calls are trading at like a 200% implied vol with 2 weeks to go. There is an earnings announcement, but even if you went outside of that a little bit here, which you're going to have premium to an extent in there, but you're still close to that 200% vol.
September 19th, 1 standard deviation move, you're still looking at 168 implied vol.
Right. I mean, and we're looking at an at the money vol of 141 in this 51-day September expiration versus, if we go back to the ETH ETF and we look at the same expiration at the money vol, I mean, it's pretty much double that.
Right. And then what is spot ETH? You said it's implied vol 65%.
Yeah, and that's coming from, we look at the Volmex data. We've had those guys on the show. We look at the Deribit data, but the implied 30-day annualized is, right now I had it, or this morning I had it 65%. You do have to look at that against the realized, though, realized at 54. So you have a premium in there, right? That's the other kind of wild thing. We're looking at IV ranks in Bitcoin at the lows, implied at 37%. Probably goes lower. We're over here talking about, get long call options. They're cheap. They can always get cheaper.
Right.
See if they go lower into August or if we get some movement out of this range. But, you got a low IV at 37%, but you realized is still 25. There's almost a 50% premium in there.
Right. That's kind of...
So you've been, even though this vol has been low, you've really been getting paid to just sell options in IBIT.
Right. Is that's what you've been doing that wheel strategy?
As realized continues to go lower. No, I stopped for a second just because we were at these really low levels of volatility. Figured, all right, it's going to pop at some point.
Right.
And there is a decent capital requirement there versus where I thought there might be some other opportunities. But if it pops again, I'll get back into that.
Yeah.
We've also had in a market environment where you haven't had much of a pullback to sell put options into that have gotten a little bit juicier on any kind of delta move. It's just been sideways.
Right.
But Dan, that's going to do it for our show. Thanks for coming on with me as always and talking about ETH, maybe pumping our bags a little bit.
Yeah.
Full disclosure, we own some ETH.
We do own some ETH, yeah.
We hope it goes higher.
We hope you own some ETH too.
Yeah, I'm trying to buy a little bit here at 35 if we get it. And I think you could see 4. You could probably push higher than that. We've talked a little bit at times about the ETH BTC ratio. Can you get back to a 10th against Bitcoin? I think you can.
Yeah.
And I think we could see some crazy stuff happen. If you do see that, I'm also going to try to sell into it and take some money off the table if you get a $6,000, $7,000 or more ETH price. I don't think that's crazy. It might have sounded crazy at 1.5, but we've been at, I think the all-time high in ETH was like 5.
Yeah.
Right. And that was before there were all these publicly traded companies that were buying billions of dollars of it.
And one last point on that.
It's crazy to say that now, man.
And I didn't hit this in the chart or the table when we showed it, but just to put this in perspective, in 2015, when this launched, when ETH ICO'd, they raised $18 million from whatever. They sold 5,000 ETH and raised like $18 million for the ICO. And now we have we have 98 publicly traded companies buying up billions of dollars worth.
ETH's market cap is $450 billion.
Yeah.
That's great.
So just to put that in perspective, maybe it is worth it to just hold and lose your account login and come back in 10 years.
Yeah, buy and hold long term has certainly been the best crypto strategy, though. Man, this is a tough market to just stay calm.
Yeah, exactly.
Awesome. Well, Dan, thanks again. That's going to do it for this week on the Tasty Crypto Show. If you are not on the email list and you want more crypto content from us. If you want more crypto, you can get that at Tasty Trade. Yeah. If you want more crypto content, sign up for the Tasty Crypto newsletter, tastycrypto.com. you'll see the email sign up there. But that's going to do it for our show. We'll be back next week on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.